The question on the table, could China step in as Russia's primary trading partner if the Europeans cut business?
In a surprising move, China's oil giant Sinopec and Zhenhua Oil have taken the dramatic step of halting oil imports from Russia. A decision with wide-reaching implications not only for Russia but also for the global energy market. This decision marks a sharp break in what had been an increasingly vital relationship. Just a few years ago, China was Russia's largest buyer of oil, relying heavily on Russian crude to fuel its massive industrial and energy needs. So, what has changed? While it may seem like a simple commercial decision, the roots of this move are deeply intertwined with U.S. sanctions. As Washington continues to tighten its grip on Russia following its invasion of Ukraine, Chinese firms now face the very real threat of secondary sanctions. With the imposition of sanctions targeting Russian banks and energy firms, companies like Sinopec and Zhenhua Oil were left with no choice but to reevaluate their position. If they continued their Russian oil purchases, they risked being excluded from the global financial system, jeopardizing their ability to trade and operate internationally. In response to these escalating sanctions, Sinopec, China's largest oil refiner, suspended its Russian oil imports in January 2025. Zhenhua Oil, another key player in China's energy sector, followed suit. The Chinese government, known for its cautious diplomacy, quietly endorsed the move, understanding that the stakes in international trade far outweighed the benefits of continuing to deal with Russia. These decisions signaled China's pivot away from Russian oil, but not just because of sanctions. China's broader strategy has long been one of diversification, spreading its energy imports across different regions to reduce vulnerability and ensure stability in its supply chains. While Sinopec and Zhenhua made the bold move, PetroChina and CNOOC have scaled back their Russian oil purchases, but not eliminated them entirely. Instead, they have opted to reduce their volumes and explore alternatives. PetroChina, for instance, has reduced its intake of Russian oil by nearly 40% in the last year. And CNOOC? They're exploring deals with other suppliers, most notably in Africa and the Middle East. These reductions show a growing reluctance from China's oil giants to rely too heavily on a partner whose future is now uncertain. But the logistical consequences have been severe. Tankers delivering Russian oil now face delays of up to 7 times longer than in the past, as shipping companies avoid areas near potential sanctions enforcement zones. Fewer shipping lines are willing to transport Russian crude. This has triggered a bottleneck in the global shipping network, raising transportation costs and making Russian oil less attractive to buyers. It's a logistical nightmare for Russia and a headache for China as well. The ripple effects of this shift are already being felt inside Russia. Gazprom, Russia's oil and gas giant, has announced 1,500 layoffs in the wake of these reduced sales. As China reduces its purchases, Gazprom faces an economic contraction it hasn't seen in years. The Russian government's plans to maintain its oil revenues are being upended. The lack of reliable export partners is forcing Russia to explore new markets, primarily in India and the Middle East, but they're encountering obstacles at every turn. India, for example, has increased its intake of Russian oil. However, logistical hurdles, such as transportation limitations and geopolitical tensions, are limiting India's ability to act as a full replacement for China. And while the Middle East could be a future market for Russian oil, competition and political issues are complicating that potential. India is now Russia's largest alternative market for oil exports. However, Russia's ability to meet India's needs with consistent deliveries remains in question due to the aforementioned logistical hurdles. As shipping delays mount and insurance premiums skyrocket, the economics of these deals are growing less favorable for Russia. Meanwhile, the global energy transition is further intensifying the strain on Russia's oil market. With more countries transitioning to electric vehicles, EVs, and renewable energy, the long-term outlook for fossil fuel demand looks increasingly uncertain. China's reduction in Russian oil purchases is a reflection of these larger trends. China is not only diversifying its energy sources but is also investing heavily in renewables. Solar, wind, and electric vehicles are the future of China's energy policy, and this shift away from Russian oil is part of a larger, longer-term strategy to secure energy independence and environmental sustainability. As China moves away from Russia, the question becomes, where will Russia turn next? India, the Middle East, and Africa are seen as potential new buyers, but each region brings its own set of challenges and geopolitical complexities. Russia may eventually find new buyers for its oil, but with each new partnership comes additional logistical, political, and economic hurdles. For now, the future remains uncertain. As China redefines its relationship with Russia, the global oil market must also adapt. In the end, Sinopec and Zhenhua Oil's decision to halt Russian oil imports is part of a much larger and more complex shift. This decision reflects China's broader strategy of risk management, diversification, and a careful balancing act in the face of global energy transition pressures and U.S. sanctions.